Hey everyone, welcome back. This week didn't come with fireworks or viral headlines. But what's happening underneath, that's the quiet takeover. From banks launching digital asset divisions to ETFs swallowing billions in inflows to the SEC shifting tone. Wall Street and global finance aren't fighting crypto anymore. They're absorbing it. Let's talk about what that really means. First up, US Bancorp. One of the biggest traditional banks in America just launched a dedicated digital assets and money movement unit. Not a crypto experiment. Not a pilot. Full division focused on custody, stablecoins, tokenization, and cross-border payments. That means they're not waiting for regulation to get perfect. They're building infrastructure now inside compliance, not outside it. And that's what people miss. The banks aren't arriving late to the party. They're showing up to buy the building. Once the regulatory guardrails are clear, these divisions become the gateways through which most of the world will interact with digital assets. Crypto purists might hate it, but adoption doesn't always come from rebellion. Sometimes it comes from assimilation. Let's talk about the number that shocked even insiders: $5.95 billion in new inflows to crypto ETFs last week alone. That's the biggest ever. And when that kind of money moves, it doesn't chase memes or hype. It moves with strategy. It means pension funds, hedge managers, sovereign portfolios, all using crypto as a risk hedge and a yield engine. And here's what makes this dangerous and fascinating at once. The more these products succeed, the less crypto behaves like an open wild market. TFS bring order, predictability, compliance, custody. They colonize volatility, turning chaos into an asset class that fits neatly inside a spreadsheet. That's the trade-off. Freedom shrinks, stability grows. And this time, Wall Street isn't fighting volatility. It's farming it. Then there's Citi. They just raised their outlook for Ether and trimmed it for Bitcoin. That might sound small, but this is a temperature check on institutional taste. It means big money is rotating. Bitcoin remains the macro play, the brand. But Ethereum and everything built on it represents utility. It's programmable money, real-world tokenization, staking yield. Citi sees where the activity is moving, from store of value to use of value. That's a structural shift. And when banks start pricing that shift, you know the adoption curve is deepening. Meanwhile, a quiet fight is breaking out over tokenized equities. Several projects are minting crypto tokens that mirror real-world stocks. Sounds great, right? Cheaper access, 24-hour trading, global exposure. But regulators are worried. Because when you tokenize a share of Tesla or Apple, who enforces the same protections that exist in traditional markets? Who guarantees that one token equals one real share? This isn't about stopping innovation. It's about legitimacy. If tokenized stocks take off, we're going to need a hybrid model, part blockchain, part Wall Street, and part government oversight. The revolution will be regulated. Something big is changing at the SEC. Chair Paul Atkins is moving away from scattershot enforcement. He's focusing on fraud, manipulation, and insider trading. But letting go of technical slapdowns and gotcha cases. That's important. Tells us regulators are finally understanding that you can't grow an industry by punishing everything that moves. Instead, they're prioritizing intent over paperwork. This might be the most bullish signal for crypto companies since ETFs were approved. Because predictability matters. If companies know what the rules are and where the gray lines begin, they can actually plan, build, and operate. Let's step back to macro for a second. The market surged after Trump toned down his trade rhetoric with China. That might sound like noise, but this is what connects worlds. Risk appetite flows like electricity. When equities rally, liquidity expands. And that liquidity doesn't stop at stocks, it spills over into crypto, commodities, and credit. That's why Bitcoin and Ethereum saw upward pressure this week, even without huge news of their own. Money is moving again. And then Morgan Stanley. They're now letting all clients, not just ultra-wealthy ones, access crypto investment products. That means millions of retail portfolios will soon have direct exposure to Bitcoin and Ether through Morgan Stanley's platform. This isn't speculative adoption. This is system integration. When a firm with trillions under management says crypto is now part of the standard menu, it stops being alternative finance. It becomes finance. If you zoom out, these headlines form a single narrative thread. The infrastructure of traditional finance isn't rejecting crypto anymore, it's rewiring itself to include it. Banks are building custody. Brokers are offering access. Asset managers are creating regulated products. Regulators are adjusting enforcement philosophy. Crypto is being domesticated and mainstreamed. This doesn't kill innovation. It stabilizes it, but it also raises the question: who gets to define crypto's future? Because once the institutions hold the keys, they hold the power to decide what's acceptable, what's investable, and what's not. And that's the quiet paradox of success. Closer crypto gets to global legitimacy, the further it drifts from its rebellious roots. What to watch? Keep your eye on three things. 1. Regulatory consistency. If the SEC maintains this measured tone, we might see a wave of corporate and banking adoption next year. 2. Capital concentration. ETFs and banking products could centralize too much crypto liquidity in too few hands. 3. Geopolitical divergence. Europe's stablecoin ambitions and US dominance in ETFs could spark a quiet currency war fought in code instead of cash. Final flash. This week marks a turning point. Crypto is not being conquered. It's being colonized. Wall Street isn't invading the space. It's reorganizing it, building roads, setting tolls, defining laws, collecting fees. And while retail traders watch charts for breakouts, the real breakout is happening behind the scenes. In boardrooms, in compliance offices, in back-end systems where code meets capital. We've entered a new phase. Crypto as infrastructure. Crypto as an operating system for finance itself. That's not the end of the story. It's just the next chapter. And the tone is changing from chaos to control. So when you hear that old phrase, Wall Street is colonizing volatility, remember, it's not a metaphor. It's a map. That's it for this week's deep dive. I'm Max, thanks for listening. Like, share, and subscribe for more sharp, unfiltered takes on the system reshaping itself in real time. Because when the next storm hits, we'll want to understand the architecture before it shakes. Catch you in the next one.